China is essentially looking at a $1 trillion debt repayment effort, and that too in countries which are up to their eyeballs in debt.
What were the original goals of the Belt and Road Initiative, and how have they evolved over time?
The origin story of the BRI, which started in 2013, is actually quite interesting. I would take you back a few more years before that, in 2008, 2009, when in the aftermath of the great global financial crisis that started in the US housing market, US Treasury significantly reduced their rates of return on bonds, which is when the Chinese state, which was at that time parking hundreds of billions of dollars in T-bills, decided to pull all that money out and actually look for bankable projects. So the largest year-on-year increase that we see in China's overseas development finance portfolio was around that time. This is the first time that AidData recorded Chinese development finance overseas to cross the $100 billion mark. This was in the year 2009. But then when the BRI was announced in 2013, 2014, and China went around the world trying to follow through on their leadership's promise to bring more projects. At that time, a lot of the developing countries already had their capacity to absorb debt at the maximum. So countries with smaller economies could not take on the kind of large debt that China was offering. So that's when China got innovative, and they came up with different ways to park dollars into projects and then to generate returns that could be used to fund infrastructure. This was done much like things were done within China for many years before that. So a typical project for infrastructure in a developing country would result from the creation of a joint venture or a special purpose vehicle, where 10 to 20% of the value of the project would be put in the form of equity by the host country, and the rest of it would come as a loan from one of the Chinese policy banks, Exim Bank and CDB being one of them. And what that did was that it created these shell companies in the private sector backed by guarantees from the host country government, but not really on the books of developing countries. And that enabled China to bring really large infrastructure into some of the world's poorest countries. And that continued for many, many years. In fact, we see that the peak of Chinese Belt and Road development financing came in the year 2017, when in a single year, they touched almost $140 billion. But since then, there's been a steady decline in Chinese development financing from that high level of 140 billion a year to about 85 billion in the aftermath of the COVID pandemic. One of the conundrums that China is facing is that despite the fact that it has committed such large volumes of development finance in all over the world, especially in low and middle income countries, when you look at Gallup World Poll data on public approval of China's leadership and compare it to the United States, they're actually facing, as of 2021, a 16 percentage point disadvantage over China. You would normally expect that as great power comes in and starts to put in projects, that its popularity among publics in recipient countries would go up. But that isn't quite happening in the way that we would expect. So what we did to analyze this further is that we divided the world into 3 or 4 categories. We divided the world into countries which are, from China's perspective, safe bets. In other words, their public opinion there is shifting more and more toward China and away from the United States. We then looked at countries which were toss-ups, either toss-ups leaning toward China or toss-ups leaning toward the United States. And then what we would call moonshot countries. These are countries which have moved more and more toward the United States camp during the first part of the BRI. And what we find is something quite interesting, which is that 2/3 of all Chinese development finance from 2018 to 2021 went into the toss-up countries, which means that China has a nervous system that is closely observing movements in public opinion toward its leadership and then adjusting its strategy to prioritize countries where they think that there is a more competitive space. And not only that, but we also find that China is quite risk averse when it comes to public relations. In countries which we would classify as being moonshots, or in other words, in the US camp, we find that only 15 or 16% of development finance money goes in there. So they know that these countries are out of their reach, and they would rather just double down in places where they know that things are going well for them, or in places where they think there is competition and they could sway public opinion toward them. I have found in AidData's research that when China faces headwinds, it tends to lay low when it comes to reputation. And when it is benefiting from tailwinds, its strategy is to double down. So take the example of Bangladesh. Bangladesh has been ruled by Sheikh Hasina, who is for lack of a better term, an authoritarian democratically elected leader who has turned her country into a one-party state. And what we've seen is that as Sheikh Hasina has consolidated her power in Bangladesh, from the year 2009, when she came to power, until now, the size and proportion of China's development financing has shifted. In the $71 million per year range during Sheikh Hasina's first term between 2009 and 13, and today they are crossing $2.3 billion. And most of this big money is going into infrastructure projects, especially high-value infrastructure projects such as the Padma Bridge project or the Dhaka Expressway elevated project, which are really helping Sheikh Hasina's government augment its control over Bangladesh by showing the people of Bangladesh that they have this ability to deliver big-ticket infrastructure. But on the flip side, if you take the example of Zambia, where China during the Edward Lungu years from 2016 to 2018 was giving out about $3 billion worth of development financing every year when they had found a like-minded development partner. But then as soon as the IMF started to push the alarm buttons and say that the debt to GDP ratio of Zambia had crossed 100% and that the debt situation was rapidly becoming unsustainable, China really backed out in a big way. So much so that by September of 2018, when Zambia formally signed on to the BRI, China had stopped all new commitments until all the way to 2020 in November, when Zambia, of course, defaulted on its sovereign debt. So it's very obvious that when things are not going so well from a reputational perspective, when they're being blamed for things not going so well, their instinct and their strategy is to check out of a country. And they do the exact opposite in places where they are finding like-minded, stable democratic leaders or authoritarian leaders who are willing to conduct development financing projects much in the same way as China has done at home.
How is China addressing poor environmental protection standards in the early Belt and Road projects?
So if you're looking at a portfolio of China's BRI projects at the moment, you will see a lot of flashing red lights. And these flashing red lights indicating problems are not just because of the debt issues that are talked about quite often. They are also related to what I would call the performance of the portfolios. So let me put it this way. In the year 2000, if you looked at the portfolio of China's overseas development financing projects, you would only find 17 projects worth $450 million as having environmental, social, or governance problems. Today, when you fast forward it, you will find that there are 1,700 projects worth $450 billion with a B that have environmental, social, or governance problems. Put it another way, the proportion of Chinese projects that have these problems has gone up from 12% to 53%. So this is really posing a significant crisis on the part of the Chinese authorities to make sure that they can reform the way that they're going about doing projects. And we have seen that since 2018, there's been a series of guidelines being issued for BRI projects to follow environmental standards. And when we compare the environmental standards in an average Belt and Road project today as compared to 10 years or even 5 years ago, we see a big difference. Chinese state-owned companies, together with state-owned banks, and in partnership with their syndicate partners, many times they are not even Chinese entities, they have significantly improved the quality of what we would call ESG safeguards in their projects, which means that in an average project, when we compare the terms that they're offering, they are comparable to a World Bank or an IFC loan much more than they were in the past. And what I mean by that is that they are imposing stricter environmental protection standards. They are requiring environmental assessment plans to be made. There is very clear rules and regulations about how to protect workers and indigenous communities. And that has really been quite a remarkable improvement in China's portfolio. In the year 2021, which is the last year AidData releases its data, we find that 60% of the portfolio benefits from higher quality environmental, social, and governance safeguards as compared to less than 15 or 20% only a decade ago.
How has the United States responded to the BRI, and how have global opinions of the BRI changed since it was launched in 2013?
The United States and its allies have launched a series of what they call alternatives to the BRI, which means that they are going to switch from primarily being providers of aid or 0% interest loans for social spending to entities that will be providing loans for large infrastructure, much like China does. So a prominent example of that is the US Development Finance Corporation, whose budgets have just in the early years of the Biden administration gone up 15 times. So the DFC is now going around the world and putting out loans, such as the big Colombo port project with India's Ambani Group in Sri Lanka, in which they are basically saying that we will do higher quality infrastructure, which has better ESG protections and therefore better sustainability outcomes. The challenge that the United States and its allies in Europe are facing is that China is not only outpacing them by giving more dollars for these projects, but China also has the ability to deliver projects in a record time. So if you compare A grade or highest quality World Bank project with an average project in the Belt and Road, we find that it takes on average 6.5 years for a project to get to commencement when it comes to the World Bank. But in our data set at AidData, we are finding that China is able to deliver infrastructure projects on average in 3.5 years, which means that if you are a host country government leader in a democracy in Africa, for example, you know that signing a deal with a Chinese bank would guarantee you almost that you would receive the project before the next election. Whereas if you sign it with the World Bank, it might mean waiting for your predecessor to reap the benefits of that. So in that way, the speed and the scale, China has a major advantage over the value proposition that the United States and its allies is bringing on the table.
What is the future of the BRI?
We are already seeing that the composition of financing coming out of China has changed. I'll give you a simple example of that. So in the heyday of the BRI, I would say 2015, 16, something like 2/3 of all development financing was going toward infrastructure projects like big power plants and bridges and tunnels. That has come down to about 31% by 2021. And what has gone up by the same token is what we would call emergency lending, which means that as countries are having trouble repaying the loans that they had taken from China 10 years or 5 years or 8 years ago, the Chinese system is using other instruments such as the central bank and the State Agency for Foreign Exchange Management, SAFE, to give short-term liquidity injections to some of their largest borrowers. In other words, the right hand is paying money to take care of loans that the left hand was supposed to receive. And that has created a cycle which is really masking the great debt crisis that we are facing in the world. AidData's data shows that something like 80% of China's portfolio is now in countries which are in debt distress. And much of this portfolio, I would say about 70% of this, will be up for repayment by the year 2030. So China is essentially looking at a $1 trillion debt repayment effort, and that too in countries which are up to their eyeballs in debt. All of this means, in my view, that in the coming years, we will see a lot of conversations about debt restructuring, debt reprofiling, or short-term liquidity injections of this variety that I was talking about earlier. Without doing this, I just don't see any credible way in which all of that infrastructure could be taken care of by way of repayments in the way that they had imagined originally. So I would say there's going to be a lot of controversy and a lot of conversation about how China will deal with the debt crisis. And some of the early indications from cases like Zambia and Sri Lanka is that China is choosing to reschedule debt on its own term in a bilateral fashion. They are not really coordinating with the Paris Club or other big creditors from G7 countries. And we will have to see what that behavior will be in the future and how it plays out in the next 5 to 10 years.